Okay, welcome back, everybody. Let's dive right into this. How do you know that you've got a good real estate deal? If you're a real estate investor, yeah, you excited for this?
I'm excited.
If you're a real estate investor, it can be sometimes a little bit overwhelming to determine, like, hey, this looks like a good deal. The price is really good. It seems to be right. But how do I know that this is right for me? So let's focus on like some key elements that make a good deal. So this way, you know, and if you want, create a little bit of a checklist for yourself here. Create a little bit of a checklist of like, these are the things that I'm looking for, or I want to check off as many of these items, these elements as possible when I'm looking at deals.
Yeah. Can we start right out of the gate with, does it cash flow?
Yes. Well, yeah, that's
I think that's the
an absolute no-brainer.
Most
If-
fundamental.
Okay, yeah. If that's not at the top of your list, then get out.
Yeah.
Right? Cash
Find the
flow
door.
is just get out of here, you bum. If cash flow is not at the top of your list, then I don't think you should be investing in real estate. Right? This is one of the key fundamentals in real estate investing. You have to have cash flow, and not just for your own pretty little pocket either.
Yes.
We're not talking about spending your cash flow. We're talking about sustainability here.
Yes.
We're talking about buying properties right and treating it like a business. You do not go and buy a business that doesn't have cash flow, right? The cash flow is your liquidity. Your liquidity is your certainty. It's your sustainability for your business. If you don't have cash flow to pay your employees, to pay your bills, to set money aside for things in the future that break, then you're not going to be in this business very long, right?
Yeah, absolutely. I think that it's it is the best safety guard that you can have on this business. And without it, you're basically just gambling. And, I'm not here to gamble. I don't think you guys are here to gamble either. I think you're here because real estate investing is safe, because you own an asset and because you know that long term it's going to generate you lots of wealth. And so cash flow is just something for you, like over long term that your property is going to do really well for you and that there's other profit centers, but cash flow is going to what is going to keep your business safe every day throughout that time.
It is the lubricant. It's the lube that keeps your business going.
Yes.
Don't be all weird about
like
it. Don't be weird about it, Diddy.
Or like Josh says, cash flow is the oxygen for any business.
Oxygen, lube, whatever. Potato.
Yes. Thank you, Wayne.
He also says the business won't survive long without it.
That's true.
Yes.
Yeah. Through all the highs and lows of market and world events and everything that goes on, cash flow is what keeps you going.
Absolutely. You need cash flow in your business. You absolutely need it. So how much cash flow do you need? Well, go buy this on Amazon.
Needs to pass the cash flow test.
There's a cash flow test for Canadian real estate investors. Okay. Very simple test. Very simple book. Go pick it up on Amazon. Okay. Very simple, very easy. This is literally your guide to determining how much cash flow you need. It is a universal formula for all different types of properties across all different types of provinces, across all different types of cities and markets, neighborhoods, you name it. Universal formula right here. Go pick it up on Amazon. Okay. 5% rule. All right.
Awesome. Oh, wow. Okay.
Dramatic.
Should we talk about projected
Yes.
ROI?
Why are you asking me?
How'd you know what I was going to say?
I don't know. Why are you asking me? Let's do it.
Projected ROI, return on investment.
Yeah. So obviously you want to be profitable.
Yes.
Does everyone know what the return on investment is?
Hit it quickly. Break it down.
Let us know in the chat. If you're live with us on YouTube, let us know in the chat if you know what a return on investment is. Because a lot of people don't. And this is the worst thing. Like, we hold events and I'll be like, does everybody understand this? I feel like I'm coaching my daughter's soccer team. Does everybody understand it? Okay, how many of you guys don't understand it? Don't be afraid. And then like 12 hands go up. Okay, just don't be afraid. Jesus Christ. This isn't U11 soccer, okay? This is real. You sitting there being all shy and ashamed and scared of what people are going to think is not going to work, okay? You have to be vulnerable. You have to let us know when you don't understand things and not be afraid to put your hand up. Return on investment is the return that you're going to get dollar for every dollar that you put in. If you're putting money in to the deal,
Like
meaning
down payment.
down payment, or any renovation funds, any dollar that you put into, that you invest into this deal, you want to know how many dollars you're going to be getting back. That's your return on investment. It's a percentage. It's a percentage. Okay. So what is the projected ROI for this deal? And does it meet your standards? Is there a universal standard for how much ROI you should be getting, for every deal or per year or per every 5 or 10 years? No, it's entirely up to you. I have my own internal standard for how much ROI I want to see. But then again, we don't really know what our ROI is going to be. That's why we said projected ROI.
Yeah.
We're going to take it based off of what do we know. I don't know what the future value of this property is going to be in the future. But what I do know,
what interest rates are going to be.
I don't know what interest rates are going to be when I renew in 5 years. Like, I don't know those things, but I can kind of guesstimate based off of the current interest rate, the historical interest rates as well. And I can see what's my mortgage pay down going to be for the next 20 years and what's my cash flow going to be for the next 20 years. Assuming some vacancies, assuming some repairs and maintenance, I can get a rough idea of what my ROI is going to be over the duration of me holding this business, say 20 years or 15 years. And then I can divide that by the amount of years. I'll see what my average rate of return is. And I'd be like, okay, is this reasonable to me? Assuming and understanding that I will have appreciation. The value of my asset will also go up, and that will be bonus bananas afterwards. But I just want to know at the bare minimum, what's my cash flow and what is my mortgage pay down going to be for the next 20 years annualized, right? So if you can get 10 or 15% per year ROI, that's amazing. That's amazing. Without any appreciation. If that's just built off of mortgage pay down and cash flow, which is almost guaranteed, there's going to be expenses. We have no idea what the expenses are going to be. We have no idea if the furnace is going to blow in 3 years. Like, we don't know those types of things. We don't know if it's going to sit empty for 2 months because you can't find a good tenant. We don't know those things. But if you can guesstimate that you're going to make somewhere in the range of 10 to 15% return on investment every year over the next 20 years with just mortgage pay down and cash flow, not including the value of the asset going up in value, that's phenomenal. That's not the standard, but like I said, what's your standard? If you don't know what that is, figure it out, because this is how you're measuring whether this is a good deal or not.
Yes.
If it's 2% ROI and you're like, oh, that's good enough. Okay, great. But I don't think it's good enough. But you got to figure out what kind of return on investment you want to see at a minimum to determine whether this meets your criteria, right? I'm going to say it one last time. There is no universal textbook standard. You have to figure out what is the minimum ROI you want to see for your deal to determine for you, is this a good real estate deal, right? Okay, that's projected ROI. Tenant profile.
Yes, we were just talking about that.
Yeah, we were just talking about this. Who is going to walk up to this front door and say, ooh, look at this wonderful basket. I want to put a Muskoka chair there. Right?
Or who's going to look at your listing and say, this fits what we need. Let's go see it, right?
Yeah.
They need to see it online and decide that it fits what they're looking for before they get to the door and decide.
Oh, you mean like overall, like bedrooms, area, location,
Yes.
that type of criteria?
Yeah. And yeah, you need to look at all of those things when you're considering the tenant profile that you want to attract. If you're saying, I'm going to invest in real estate, I think one of the major considerations you should be making when you're deciding on a asset class is, what type of tenant profile do I want to manage? Do I want to attract?
That is a very good
in
point.
My properties?
That's a very good point.
Right? Because if you're thinking that you're going to have a lovely young family and then you're going and buying an apartment building full of 1 and 2 bedroom units, that's not who you're attracting, right? So getting clear on the types of tenants that you want to manage in your portfolio is important. And I'm not saying go and be, don't say like, oh, I want to attract doctors because they make a lot of money. Because doctors are probably buying their own houses because they make a lot of money.
That's going to be increased vacancy because they're going to be moving a lot.
Yes. So you need to be realistic about who is out in the rental market looking for rental properties, and then decide, out of these different classes of people, who do I want renting from me, and then what properties fit what they're looking for.
Yeah.
Right?
Do you think it'd be reasonable to buy a house that has a secondary suite and be like, oh, I'm going to rent to doctors in my basement suite?
Absolutely not.
This doctor is a specialized neuro Give me a specialty in medical, in the medical field.
I don't know.
That's a heart surgeon.
Yeah.
They're gonna rent this 2-bedroom basement suite with their 3 kids.
Because it's near the hospital, right?
Because it's near the hospital. If I'm near the hospital, therefore I'm gonna get medical professionals.
Yeah. Probably not. Yes.
Sorry, maybe that one was a little too much. We'll cut that out. You have to be on the live show on video to be able to see that. But seriously, you got to think. Is that a reasonable thing to request to people? You have to
That
think.
they think, yes.
You have to think. You got to use your head,
Yeah.
right? This isn't rocket appliances. This is really simple stuff, guys. This is really super simple stuff. So you have to think about it. Obviously, the first 3 things that we talked about was mainly related to the profitability and the numbers, the business side of it. And we want to make sure it's profitable. We want to make sure it's sustainable, that there's a sufficient amount of cash flow. We want to make sure that it meets our standards for the types of returns that we want to get, right?
Yeah.
But also, we want to make sure that we are being intentional with the types of properties that we're buying. Hey, this property is a phenomenal, money maker right here. It's got so much potential. It's got great cash flow. It's got great projected ROI, right? But it's going to attract these type of people. And sometimes, even though you want to attract certain types of people, this is the types of tenants I want to get, right? You're going to get whoever responds to your listing, right? You might not even get the tenants that you're really hoping for, right? And you need to be okay with that. So who is going to be attracted to something like this in this area with these types of, with this type of layout, with these amount of bedrooms, right? In this type. So let's talk about the 3-bedroom townhouse that we got an offer on, that we got accepted. I mean, that one there, it's going to attract a certain group of people. 3 bedrooms, obviously it's going to be families. Very, very unlikely you're going to get single people, right?
Yeah.
You're going to get families. Now, in a complex, in a C to D area, are you going to be attracting, high net worth individuals?
No.
With good paying jobs? Probably not. And you need to be okay with that and comfortable with that. Even though I want to attract this person who makes this much money, you're probably not going to, just based on the fact the product that you're trying to sell them is not appealing to them.
Yeah.
All right. This comes down to affordability, right? So you have to buy the property with the intention of, you have to think about who you want to rent to first before you buy the property. You think about who you want to rent to first, and then you buy the property for that person.
Yeah.
Right? It's kind of backwards. You kind of have to reverse engineer it a little bit.
And I think also what people don't realize, or some people don't realize, is that who you're attracting and who you're renting your suites out to actually does affect your returns.
Yes.
And so, you talked about how earlier, we talked about cash flow, we talked about projected ROI. Those things are all related to your profits, but so is your tenant profile.
Mm-hmm.
Because the amount of turnaround that you have relates to your profit. The amount of wear and tear that they do on your property amounts to how much profit you make.
Sing it, sister.
Yeah, so there's all these things that, if you have a lower standard of tenant profile, maybe in, insert a property type that would, apartments.
Yeah.
Might, those
Absolutely.
1-bedroom apartments might attract a lower tenant profile.
Low-rise multifamily.
They might smoke in it. They might have additional wear and tear.
Hey,
They
we
might
were driving
actually
down,
damage it.
what were we driving down? 149th Street yesterday? 156th Street yesterday? Gabby?
Yeah.
Go, no, Gabby, hang on a second. Why don't you tell everybody what you told me while we were driving down 156th Street yesterday? Why don't you tell the class what you said?
Leave me alone.
Tell the class what you said last night.
Leave me alone.
Tell the class what you
Don't
said
make
last
me.
night.
Don't. This was private, Wayne.
It's the same fucking thing I say every time I drive down that street.
Space.
I'd rather fuck a kangaroo.
No, I didn't say that. I said, who would in their right mind want to own one of these buildings?
Oh, they're just so unappealing.
Oh my God. And just the
How do people stand in front of that being like, look at what I just bought?
And the people walking down the street and the people walking into those buildings and all of the junk on their balconies and all of the crap hanging in the windows. Like, I was just...
the people walking in, the people walking out.
I know that that's not what we invest in. That's not what we want. That's not who we are. But just looking at it, I was like, how does somebody look at this and say, yes, I want to own that building.
Mm,
Like, I don't know. I don't know.
I
Just,
don't
I
need.
don't know, guys.
Mm, yeah. Every
Anyways,
time I drive through there.
yeah.
Well, any like, because a lot of multifamily buildings are all like on the same street. It's
Yeah.
all like it's just littered. It's multifamily row.
Yeah.
And where there's one, there's lots, and then when there's lots of those, it's like it's the type of it's the type of crowd that tends to frequent around that area, and it just attracts a certain vibe in that area, and it's just like, oh dear God. And you can smell it. You can smell it from your car with the windows up. Like it's ugh. Anyways, you do you. But what were we originally talking about? You
But
said like what
those
those
are
types
gonna
of units,
attract,
those types of units, those
yeah.
types of buildings.
Yeah, they're going to attract a lower class of tenant, and you're going to have way more upkeep. You're going to have lots of turnover. You're going to have tenants defaulting on rent. You're going to have evictions. You're going to have to be collecting from people. You're going to have a job that I assume most of you here listening don't want to have.
Yeah.
That's certainly not the job that I want. I want chill tenants who are going to pay their rent, who hopefully will stay for a long time. But if they don't, and if they decide to move, I'm not going to have a problem finding another tenant who wants to rent that unit, who is going to do the same thing the previous one did,
Yeah.
take care of the place, pay rent, and I can just, I can be a landlord, but I don't need to be throwing people out and chasing down money and all
Yeah.
that kind of stuff. I mean, at this point in Wayne and my investing careers, we do take on a little more risk here and there,
Calculated.
calculated risk, because we're experienced, we know what to do, we know, it's not a big deal anymore. But for, people who are starting out, I really highly recommend easy.
Yeah. It's and that's what we teach. We teach simple, we teach easy.
Yeah.
And our students just continuously keep hitting home runs and grand slams because they just focus on simple and easy. But it can be a little confusing sometimes not knowing what simple and easy is. You know what I mean? If it's under your assumptions, so like, okay, I'm just going to do something simple, something. So most people will be like, okay, I'm going to do something small. I'll start with a small condo and just kind of work my way up. But that doesn't necessarily mean simple and easy. We're talking about fundamentals here. So we want to make sure that it cash flows. We want to make sure that it's a good ROI that meets our standards. We want to make sure that it's a tenant profile that we actually want to rent to and that we're doing it intentionally. We're thinking about that tenant profile first and we're buying the property with the intention of selling a product that that tenant would want to rent from or rent, sorry. Thank you. So those are the things we want to make sure that we're being intentional. And that's what you should be doing, is thinking about intentions first. There is a certain amount of cash flow I want to get. There's a certain amount of projected ROI that I want to get. There's a certain type of client or tenants that I want to service. What property will get me that? See what I mean? We're going backwards here. We're not going forwards. We're not looking at a property and saying, is this a good deal? We're reverse engineering it. We're beginning with the end in mind.